It's time to go to the atomic level. It's time to go.
Welcome to the Atomic Level, the show where we decode the matters of wealth one insightful conversation at a time so that you can grow and protect your net worth and net happiness. I'm Chris Snook, and today I am joined by Matt Cape of Consilient Capital, and we're going to talk about something that isn't in the news cycle, but that you need to be paying attention to if you want uncorrelated returns in this market, especially in the world of AI. Matt, welcome to the Atomic Level. I look forward to hearing more.
Great, Chris. Hi. Good to meet you.
So you are currently in London, I can tell, not just because of the tea, but also because of the accent. Whereabouts in England are you based? Are you right in the city?
Well, actually, just outside London. I'm in Windsor. So I can get into London. I can also get to the airport.
All right. I feel smarter. I feel smarter already. You know, Americans always feel smarter when they talk to a Brit. I had James on, our friend James Godfrey on episode 007, and I felt both tough and smart listening to him. So I look forward to diving deep. I've heard a lot of great things about you, but for the audience, as they know, we do these unscripted, and I don't have a lot of idea of where we're going to go with this conversation. I just know that I'm really excited to have it with you. So before we get going, Matt, just talk to us a little bit about your perspective, what shaped it, and kind of the road to where you are today. Like, what did you do? How did your career arc evolve? And then let's talk about Consilient and what you're doing today after we warm up.
Well, I mean, like most things, I kind of fell into it. So around 2000, I started working as a shipbroker. So looking as actually shipping analyst within a shipbrokers. So looking at the shipping market and determining where cargo is going to, where it's coming from, and trying to work out what's happening next in order to inform the brokers when they are talking to charterers and ship owners. But moved from that in 2000 or 99, just before 2000, into .com, which was a big thing 25 years ago. And that particular thing, that was looking at the market for marine fuel, very niche. So you've got all the world's ships are basically burning big, ugly, heavy fuel oil over a 30-day period. So they'll go into port. They've got no idea what the price is, and they've got no idea who's supplying it. Well, they certainly didn't 25 years ago. And they're looking for a price. They're looking for some confidence over who's providing good quality product. And we used to essentially ring around the market all around the world, finding out who had product, what price they're selling at, provide that to ship owners. And then we moved from that to providing kind of credit information on shipping companies to the bunker suppliers. Because the dynamic of the market is that they would buy the fuel, they would load it up, they'd then leave port, international waters, and burn it. And then maybe, if they were lucky, 30 days later, they'd get a check. They wanted to know they were going to get paid. So we had an investigations team that worked on that. I mean, eventually we had a company which was based out of Singapore. We were in Mumbai, Miami, and Vancouver. So we had kind of 24-hour coverage on that. And I was saying it's a very niche market. And then in kind of 2016, having done that for 15 years and built it up into something quite interesting, we sold out to Standard & Poor's, their division Platts, which meant that, I mean, I built that up with a business partner. We sold that out, and we had options to look at new things. Getting into trade finance, it was a realization that the people we were selling our pricing and credit information to were happy to buy it, and we got a nice premium on it. But basically what they all wanted was finance. They wanted to have assurance that they were going to get paid. They wanted to get insurance, which is where they got their credit reports to in case they didn't get paid, that they would get money back. And what we were trying to do for most of that period of time was build out a trading platform and finance for it, which was infinitely more difficult because you need to have pools of cash. So when we sold up, it was recognizing that although most of the world's banking is done out of Europe and North America, most of the world's commodities are in Africa and Asia and Latin America, and they're underserviced. And we started working on a trade finance strategy that recognized the fact that when you're sitting in London or New York, you haven't really got an idea of the scale of these companies, and you certainly haven't got an idea of how creditworthy they are because they're based out of India. You haven't quite got the view of that company; they're a long way away. You're not really sure about what assets they have in the land that they hold or their factories, and consequently, you're more inclined not to give them credit than to give them credit. The approach that we came upon was recognizing that these companies had real assets. They had 20,000 tons of coal, or 5,000 tons of sugar. These are real world assets that are sold on the international market and have a market price that you can track, you can see, and if you can secure the money that you're extending these companies against that commodity, you've got all this. It's very liquid. You can take it to another port and you can sell it if they default. So that was the kind of the genesis of our trade finance, how to term it. I mean, that was the realization that there was a trick that's being missed because the banks were looking at the same companies and trying to determine how creditworthy they were based on their balance sheet, and running into trouble when it comes down to determining whether they could actually extract money from them in the case of default.
So that's a great setup. I want to unpack some of the history of that industry through your perspective too, because I think it's a good setup for kind of what's changed, what's not changed over the last 25 years, but also maybe the last 300 years, and then what it kind of looks like moving forward, right? And because at the end of the day, we're talking about real world assets floating over oceans, and the people that are part of that two-sided or sometimes multi-sided transaction being properly remunerated in time for taking the risk of putting it on the boat and getting it over there, but also for taking the risk of buying it and making sure that it gets delivered on time. And the financing of that activity is something that has been ignored or maybe abandoned at different periods by the traditional banking system, but that as a sizable market is in the trillions of dollars, I would imagine at any given moment on the water. Talk to me about what you can, that sets us up for understanding kind of what has never changed, but who's rotated in and out in the role that you guys are currently playing, as far as who were the capital providers, a couple hundred years ago when we didn't have any way of knowing, and we didn't need fuel. We had wind, and we hoped that the wind blew, right, instead of the gas being affordable and discovery. And then I thought it was interesting, to also think about, it was only 25 years ago that a ship wouldn't know where they were going to fuel up, what it was going to cost when they got to the other side. I mean, that seems like something that would be in the dark ages, to most of us now, because we forget that 25 years ago, outside of maybe a CB radio or something, or a satellite phone, there was no way to communicate over the water, with the other side in real time. And now, what does that look like today? Not just with fuel, but with other things, whether it be conflicts or other things, and what role and then what is the hole in the market or the problem in the market that you guys are uniquely solving this time? So answer any and all of those, but kind
Any
of take
order.
us back to talk to us a little bit about the history, because I think it's fascinating to understand the future through the lens of how we got here and what that industry still relies on that isn't changing.
Well, there's a lot in that. So, I mean, you've got 10% of the world's commodities or trade is transported by ship. So it's all happening in international waters. So consequently, it's almost invisible. If you're sitting in a port, you can see the ships coming in and out. But at any one time, most of the world's commodities are at sea. They're in a ship. So that is kind of the hidden market, because it's not in any one location. As to why, going back to 25 years ago, they didn't know where the ship would be bunkering, is basically you'd have a situation where you'd have a 500,000 ton ultra large crude carrier, super tanker, loading in the Gulf of Mexico, beg your pardon, the Arabian Gulf, coming out, and the instruction that's been given is basically turn left or right. Is it going to Europe or is it going to Asia? And that would be it. And on that voyage, that cargo could be traded 5, 6, 7 times with different end destinations.
So understanding that, pulling out layman's terms, I'm the captain. I'm pulling out of the Gulf of America now, but back then I was pulling out of the Gulf of Mexico, and I go left, and while I'm going left, the cargo, which is 500,000 tons or whatever you said, right, on my ship, is changing owners somewhere between 5 to 7 times before I even get close to where I'm supposed to drop it off. So
it could do, yes.
It could, and so that's probably that kind of churn and that turnover, and is probably more common today. Maybe it trades hands more times, maybe it seems less, but that makes sense. So while I'm en route, the receiver is a different person, and I won't really know until I get within a certain distance from the port, is what you're saying. And I might be going to a different port than I thought I was going to. Is that accurate?
Yeah, absolutely. I mean, you actually, as you're getting closer, your options are closed down. So the closer you are to east coast of China, chances are you're going to be going to a Chinese port. But you don't know that when you're going past Singapore. It could be any one of those locations. And so, in the market we were looking at the end of that voyage, you're going to need to refuel. So when you don't know what's happening next, you need to be able to keep an eye on your options. But that was kind of shipping market, and it was always why it's fascinating. On the commodity side, the big change really happened after the financial crisis. So
after 08?
Yeah, after 2008, yeah. So the additional regulation that were placed on the banks to ensure, well, from the perspective of regulators, that it would never happen again. Well, they created other problems. Basically meant the banks were having to do a degree of due diligence on their clients, on these trading clients, that made it uneconomic. So very early on, we were talking to a big Swiss bank, the trade finance team there, and they were offloading what they termed SME traders. Now, they classified an SME trader as any trading company that had a turnover of less than 500 million a year. Now, that's in the context of European American companies and the big trading houses. Yeah, that's possibly is an SME trader. In the context of Indonesia or India or most of Africa, that is a very large company. They're now no longer able to get any trade finance. So who stepped into that market were the big trading houses. So the Trafigura's, the Glencore's, the Cargill's. They stepped in on all these commodities, and they were able to raise money very cheaply because they are, in most cases, listed entities or certainly registered in first world countries, where the banks are very comfortable with their credit profile and able to determine exactly how exposed they are to them, and they're able to provide all kinds of other services to them and issue notes on their behalf. But that meant that if you were a Indonesian coal miner and you had a wonderfully producing coal mine sitting in a part of Indonesia, very easy access to India, or you've got two countries there that sit outside the kind of comfort zone of a large chunk of the banks. But you'd have Glencore stepping in, and they would basically, the only option the miner would have would be to sell their product at port to the trader, because they couldn't get the financing themselves to transport it over the sea to a potential market, a potential client.
So they were self-financing it then. In that scenario is what you're saying. They were taking all the risk.
Well, so
hoping a buyer was on the other side. Is that right?
Well, these companies would have been forced to self-finance in order to. They were not able to raise the level of trade finance that they wanted, that they would need to do this on the volumes they wanted to do. They wanted to get volumes up. They would have to basically sell a larger portion of their output to the trading companies, who of course are then looking at maximizing their profit as traders, as you'd expect. And that's what we're all about.
Right.
So they would then buy in bulk at the cheapest price, having raised funding from the banks at very nice low interest rates. And
basically free money. They were getting free money from the banks because they were quote unquote credit-worthy U.S. or European traded institutions. So they're basically borrowing for free, and then they were arbitraging the other side, buying in bulk at a discount because that person couldn't get any financing, and something was better than taking all the risk that it fell into the ocean and I lost 5,000 tons of coal and had no money to prove for it. I'll take what I can to keep my volume where it is. Is essentially the scenario that they were faced with. And the arbitrage that was available now post 08 to the larger trading houses that were listed entities and could create a financing division.
So what you have then is the smelter or power station in India that has a genuine need to buy coal, and you've got the mine in Indonesia that has coal coming out of the ground that it's loading up in port. These are two entities who have a desire to do ongoing business, but they can't trade with each other without going through an intermediary. So in that case, that was the likes of Glencore, who would then buy the cheapest and sell the maximum, and they're maximizing their return. Now, our approach basically is to take a banking return, but a nice healthy one, but taking kind of a trading approach. So we would come in, we wouldn't be looking to maximize, but we're basically looking to maximize the transactions we're doing with the minimum risk. So what we're determined to get is a nice, consistent, a risk-adjusted rate of return of between 8 and 10% and 8 and 12%. That's what we're looking at in the current market.
Okay, so before we get to that, and I don't want to, I want to do a slow simmer here, because I think there's a really interesting box that you guys check in the alternative asset portfolio right now around uncorrelated returns, and I want to kind of build into that by understanding either the stability or the volatility, because I don't know, of trade finance as it were and as it is today through the lens of the great financial crisis. Because what you talked to me about was in 2008, right? What everybody thinks about that remembers 2008 was the market crashed horribly, housing dropped 40, 50%, 90% in some markets, right? Everything blew up in 2008, and we had to bail out the banks, otherwise we were going to lose the global economy, right? Iceland went bankrupt. We had all this systemic risk. And so through that lens, a aware mind, like mine was before I started learning about what you guys do, would think that, well, where does my money sit and earn me a, better than average return when banks are forced and central banks are forced to cut rates to zero. And so one of the things I heard was that publicly traded entities that were able to do the trading aspect or the trading operation of this became intermediaries, and they became the almost forced counterparty risk that the Indonesian coal miner and the Indian power company had to use now, whether they liked it or not. They had to go through this third party to get their product, and they had to pay and take whatever it was worth on both sides of that equation. And that third party was able to create a nice return because they were borrowing at zero and selling at whatever they could push into the market. So you could argue that was one way to play it, which was, buy the stock, I guess, of that third party company. But you had to know that that's what they were doing, which may or may not have been very obvious to people. But talk to us about what happened to trade as far as volumes or returns or losses during that 08 to 2011 period, where we were really in the throes of recovering from the financial crisis. Did it stay stable? Did it keep moving? Was it impacted by real estate? Was it impacted by stock? Talk to us just in general about what happened to trade as an industry and the volume of stuff moving over the seas, because I think that's interesting context to have for how it correlates or uncorrelates to other bubbles.
So actually, it's an interesting one. I'm actually, when it comes down to the volume of trade going up or down, it's pretty resilient. The issue really is the shortfall in trade. So the estimates from the kind of Asian Bank and the World WTO that the unfunded element, or that the element of what currently is in need of funding is basically unmet, is between 1.5 and 1.8 trillion US dollars. So these are transactions that are there that are unable to be made at present.
And these are on a monthly basis, on a weekly basis. What is that 1.5 to 1? Is that annualized? What is that?
Annualized.
Okay. So right now, what you're saying is, right now today, there is 1.5 to 1.8 trillion dollars worth of transactions that cannot occur this year because they can't get financed to take it from where it is to who wants it.
Yeah, and if they are able to getting it, they're getting it at such a high rate that money is being captured by the banks or the trading houses. So you've got, when you have a shift currently in the world economy, increasingly the biggest growth opportunity in the next 10, 20 years is Africa. That's going to grow faster than any other region. And yet most of the profit from that trade is going to be captured by the banks at present, where you've got smaller companies that could grow into very large companies, are unable to get the financing locally in those countries. At the moment, it's very much captured by those who are able to get funding from the European banks. That's great for us, living in the US, living in Europe. At the moment, that would appear like we're going to capture it. Reality is the Chinese are, and the Africans aren't. Our strategy really is recognizing the opportunity lies in country. It's in Africa, it's in Indonesia, it's in Asia. These are the entities that are growing. They're the ones who've got resources that they want to sell, and they have got demand that they want to meet. And if we can fund that, then you're actually directly injecting into the economies in those regions and profiting nicely.
So the business model then is, how is it different than the banks, in the sense of, it sounds like part of what you're doing is you're allowing this transactional volume to actually have the impact that it should have in the location where it's occurring versus in the money centers that have existed for the hundreds of years before it. So as Africa grows, and starts to trade rare earths or whatever more with the rest of the world, what you're saying is your funding mechanics not only make a stable, consistent return at the fund, but also allow Africa, for instance, to benefit from this volume that they're doing versus just be washed out with fees and interest and money moving out.
Yeah, I mean, that we're able to do that. That very much is a benefit. The approach that we have, we think is recognizing where the asset is that you can actually secure your funds against. Now, if you're big Swiss bank, you're looking at a European or North American company that has a balance sheet that you're comfortable with, that if there's an issue of a non-payment, you can go in there and you can get your money back. We're saying, well, that's fine, but actually the asset you want is the coal, because that has a market value. So if we basically, our structure says, well, we'll recognize that value. We will buy that coal and we will sell it on your behalf. We are secure and we are covered, and you have a direct relationship with your buyer on terms that are totally transparent. But as a Indonesian company or Indian company or East African company, rather than having to sell it via a what is currently deemed a creditworthy international trader.
So I got it. So I think I got it. Let me ask you if I understand it. So the difference in business model, simply put, is that Consilient is actually buying the product, taking possession of it, theoretically title to it, at day zero. So I'm an Indonesian or I'm an African, miner or trader of whatever I'm trading, and instead of me getting, which I can't get right now, but assume that I could, instead of me getting a very high interest usury level loan from XYZ bank and keeping possession of my asset until it's picked up by the buyer on the other side, I am selling it to you today at some deposit level discount or whatever, but I'm basically selling it to you. You're taking title, and that is my guaranteed payment before I've put it on the boat. Then when it arrives at the other side, you're selling it because it's now your asset to whoever the original buyer was. They had the transparent terms up front, but you're selling it to them. If they disappear, it's your asset, so you can find somebody else to sell it to. And whatever that end price is, you're kicking back some second payment to the original commodity owner or creator, but you're keeping the spread. Is that accurate? Or
no, not quite. No, we would go into an existing transaction. So you've got a buyer and a supplier. They've already agreed terms. They're already got probably some degree of financing in place, but they want to increase the business that they're doing. Or maybe they've only got 30% of trade finance and having to fund the other 70%. But it's an existing transaction. We're coming in with both parties, contractually with both parties. So we're buying at one price and we're selling at the other price, all predetermined at the same time. Within that spread between the buy and sell price is our margin, which would be, on a 30-day term, say 1%. But it's totally transparent. We know that the buyer has an ongoing demand for it because it's going to be ongoing transactions, and we know that they've already previously done purchases from the supplier, and that they run this power station. They have an inherent need for steam coal, so we know that actually they're going to be buying it going forward. Likewise, the mine has got. I'm thinking about coal, which is decidedly only one of the areas we're looking at, and decidedly the most polluting. But it's quite illustrative. And we know that they are producing coal on a monthly basis, which they need to sell. We're stepping in 2 contracts and organising the shipment. We control the ship on behalf of the supplier. We have agreed terms in which we are buying from one and selling to the other. Total transparency. The deal's complete. We then fund that, knowing that we actually have a buyer. If that buyer were to collapse or go under, we own the cargo. We have also, in the terms of the contract, depending on the volatility of the commodity that we're dealing with, we're also requiring the buyer to make a prepayment. So it's called, if it was highly volatile, the market price is highly volatile, it could be up to 30%, but maybe 10%. They prepay us. So we now, at the point we're entering this transaction, have 10 to 30% cash and full title and control of the commodity. So we, as far as our investors are concerned, they are 130% covered. We run that transaction for 30%.
Right. So they're got it. So essentially, and this is filling the white space of $1.5 trillion worth of unfunded transactions. So you're going in to $1.5 trillion void that is ready to do business but can't, and you're basically just becoming the transparent counterparty to both sides that ultimately holds the real world asset, whether it's coffee beans or coal or lithium battery, it doesn't matter what it is, while it's in transit, and you're averaging somewhere around a point of interest per month in that scenario, and you're buying it with a spread between the bid and the ask.
Yeah.
And then you're requiring some down payment from the buyer on the other side. And if they go bad, you keep their cash and you have the coal or the lithium or the coffee beans or whatever it was to sell to somebody else.
Actually, we had independent analysis of it, which was quite fun. So they went through a PhD mathematician who had previously worked consultancy for S&P and Moody. Went through the analysis and said, right, if you have a default, you make more money because we will have 10, 30% cash. We'd own the cargo as well. There's a default. We keep the cash. We redirect the vessel. We sell that on, either put it into storage and sell it on the futures market or sell it directly, and we keep the profit.
Right. And if somebody steals the cargo in transit, a pirate, whatever, insurance,
we're fully.
yeah, that's okay. That's okay. Something froze on your end, I think. So I said, if it gets knocked over, somebody sinks the ship crashes, pirate comes and raids the ship, Captain Phillips style. Insurance is in place, and you are the insured and the commodity owner while it's in transit. So what happens then? 100% coverage? How does that work?
We're 100% covered. We're fully insured for loss of cargo.
And how about the 10% or 30% deposit? What is is that cap on account for the next shipment for that buyer, or how does that typically work usually in that scenario, which doesn't happen often, but if it did?
That's a good point. I mean, we would look to return that because we were unable to fulfill that contract, and we look to be able to deliver again. I mean, at the inconvenience there, if we were to lose a vessel, either sinking or to piracy, is that we would have to wait, 30 to 60 days or whatever it is for the insurance company to pay out. But we would get the money back.
Yeah, which I think, again, I think you said it was Lloyd's of London, right? So, you've got as much certainty there as you're going to have, and people know that they're going to slow pay, but the money's going to come. And so that, and the buyer knows that their 10 or 30% deposit is going to be essentially a credit on the account until it's earned, and earned means I got the product, but if they default, it's lost. So if they default, it loses. If something happens on your end that fails to perform, they get it back, and they can wait for the next shipment and transact with you again. I think you're there. I'm not sure if you heard that part or not.
Yes, sorry, Chris.
If you want, we can turn off the video because that might help. I can hear you great. Try turning off your video because it's a podcast anyway, and we'll clean up the edit there. And that might give you better bandwidth. It looks like I've got 5 bars, so I'm not sure if it's on your end or not. But okay, so I'll re-say that. So we'll do a double clap. So what it sounds like is if the shipment gets damaged in transit, then insurance will pay out however fast or slow they pay out, but that money is coming. The deposit gets returned to the buyer on that transaction. They can then do another transaction with you in real time, like leave it there and say, don't send it back, just leave it there. We'll do another buy, and then they have a time horizon and a contract on that. And a new shipment gets put on a boat. But at the end of the day, what I heard you say is somewhere between 110 to 130% coverage of the actual dollar that is on the water is what you guys have in your model. So as you think about risk-adjusted returns, where would you, or where can you, per the regulators, market this? Is it risk-free, uncorrelated? Is it what is the right term to say?
Well, we have an implied risk of AA. It's implied. We haven't got it rated yet. We are working with we are partnering with a regulated fund manager who are part of the Altair, who are part of the team. So we are within their fund structure, and they are specialist trade finance fund, been operating for 10 years plus, 12 years. They've got a trading history for, and we have partnered with them because they have that special that experience, 12 years in African commodity trades. So we are fully regulated. We are insured. Our cargoes are insured, but our structure is not a lending structure. It is a kind of a non-credit approach, which is secured. What's the word? Overly secured. I mean, we have nice heavy security over both the cash, the prepayment, and the commodity itself.
And kind of talk to me a little bit about the infrastructure that you guys need in place. I mean, is this done mostly via the computer and the phone? Do you have a branch in either Lagos or Ghana or somewhere in Africa? Is that necessary? Talk to us about the footprint of Consilient and then what your growth plans are. I mean, if there's $1.5 trillion unfunded out there right now annually, you guys, to my knowledge, are not $1.5 trillion fund. And so, how much growth do you see ahead, and what's kind of is there a cap on the fund? Is there a sweet spot that you're focused on and kind of going to stay within as far as size and range of deals? Or talk to us a little about those mechanics.
Okay, we're very ambitious. This is why we partnered with Altair. We could have done it on our own and start up and take in 5-10 million and start proof of concept on that 5-10 million and see if we can get up to 100 million over 3 years. We're going with Altair. Altair have got 600 million under management. We've introduced our strategy into their fund structure, and they have pre-funded our strategy, so that we have currently 32 million within the fund, with a further 15 that is currently being onboarded.
And are you and you guys are obviously taking in new capital? Are you
Yes.
Are you looking at structures for being listed inside of maybe an alternative asset index fund or something like that, where you like a fund of funds where you could create ongoing allocations from advisors or from networks of people that want exposure to the asset class with a mix of uncorrelated returns? I think you said a 9 to 11 range. What is the roadmap there as far as partners for ongoing capital investment?
Well, we're looking for kind of a minimum investment of kind of $250,000. For us, the issue is ensuring that we have quality transactions. So that doesn't happen. We can't immediately place funds. We have a pipeline of about over $100 million worth of transactions that we can feed into at this point. And we will be extending that as we go forward. But with
Gotcha.
with
and
all
those $100 million worth of transactions, they're recurring on ballpark a 30-day basis, meaning, like, let's say that all 100 million that you have in the pipeline right now was deemed creditworthy by your standards, and you had 100 million to deploy from the fund. Right now you have close to 50, it sounds like, coming in, and 32 already in. And so let's say you deployed 100 million. Would then you turn that money again 30, 45, 60 days later? What's the turn on that money? How many times a year does that turn if you just stayed with 100 million?
The transactions vary, but between 30 days and 180 days. We are looking to maintain a balance, an average of under 90 days, because part of our offering is that we could give redemption within a 90-day period. So you've got all these transactions are self-liquidating, and that's the other beautiful thing about the strategy, is that you're not putting money in and it's locked up for an indefinite period of time, and then you're looking to redeem your funds. But terribly sorry, we've got a factory that is currently in construction. It won't be finished for 2 years, and it'll take another 1.5 years to sell. These are self-liquidating transactions. So we make the investment, it comes back in cash, we make the next investment, and we're looking at ensuring that our average transaction period is 60 to 90 days. So that because part of the sales proposition is you can put money in and you can get it out within 90 days.
And basically my expected, caveat, all the risks and all the disclosures, blah blah blah, but the projected annualized return with a 90-day redemption option is roughly 75 basis points a month, 60, like, to the investor after fees and after everything like that. Are they looking at like a 9 to 10, a 9 to 11% asset backed kind of return finance? What are they projecting?
We're kind of targeting always been targeting 50 basis points over say for 3 months, so that it's a nice healthy return on as opposed to putting into the bank.
Gotcha. So right now, someone that might be thinking about learning about this, and that is a high net worth individual with a self-directed IRA. Maybe their advisors handle a lot of their other more traditional stuff, but maybe they have some real estate, or maybe they have some gold and silver stuff that they do, or maybe some Bitcoin that they do, or things like that. But they, their money market has been where they've kept a significant amount of dry powder because, hey, 5%, quote unquote risk free in a money market account has looked great for the last several years with all this uncertainty with AI, with markets kind of being volatile. Like, maybe they're sitting on the sidelines in cash. $7.4 trillion was the number that I saw, 6 months ago, sitting in cash, right?
Yeah.
And so if someone is a self-directed IRA or sitting in cash heavier than they'd like, but doesn't want to have, a speculative strategy and is looking for a 6 to 9% kind of net of fees return, this could be an option for some of that cash. Is that the right kind of persona?
Absolutely. In fact, we've also got a structure and terms whereby we can take stablecoin. So you could actually invest stablecoin. So there'll be no need to redeem stablecoin into US dollars. We can take stablecoin and provide you a return on that.
Got it. So it doesn't matter whether it's a tokenized dollar or whether it's a paper tokenized dollar. If it's digitally tokenized as USDC or USDT, or if it's tokenized as a US dollar on a Chase Bank balance sheet, you'll take it.
Absolutely.
And so that's good. So then if they are a family office, or if they are on the upper end of that, I'm sorry, what was the minimum again? So the fund will take, was it 100,000? Was it 50,000? What was the minimum?
250,000.
250,000. Okay. I thought it was higher. I was like, it couldn't be 50. So if someone's got, $250,000 sitting in cash, earning them 3 to 4 to 5%, or not performing, but sitting in gold or silver, and they want to diversify into something that is commodity based, real world backed, like, you're actually, your money's not only got insurance around it and principally protected, but it sounds like, and I don't want to use words that I can't use and get you or me in trouble, but it sounds like basically if they want something where their principal is backed by a real world asset, 1-to-1, and has a return in the almost double digits, but high net of fees, north of 5% annually, and with a redemption period of 90 days, if they got $250,000 or more that they want to throw at that strategy, you'd like to talk to them. But if there's an advisor that's managing 200 to 300 families, and maybe they collectively have a thing, what is the path that you guys are working on through that world, or do you have one yet, as far as making it easy to have an allocation in without the advisor having to do a ton of paperwork?
I mean, on how much paperwork to do, I mean, that would be another question. We are, it's a relatively streamlined process. We would bring you in. This would be the advantage of actually working with an established fund manager out there, who are based out. The fund is based out of Cayman. They're operated out of Mauritius, and the reason being that we're managing lots of funds out of Dubai and the Middle East. I mean, that's the structure which we'll be investing in. We can take US investors. We can take, global investors.
And your regional focus, you've said it before, but I just want to make sure we're not limiting. You guys are very focused on serving the transactions coming out of Africa to the rest of the world, and/or what other regions are you originating from?
Well, Africa is extremely rich opportunity for us. I mean, and that recognizing it's heavily underserviced, and our focus is on non-perishable commodities, and there's a lot coming out of Africa. We are also looking at Latin America, and have experience out of Asia as well. Europe and America, Europe and North America hasn't been our particular focus, although that will come on later. They're well serviced with finance already.
What without this being this is not a political question. This is just a seeing the world as it is question. With the reordering of geopolitical trade agreements and alliances and tariffs and everything in between, right? And I'm not asking it as a judgment of good or bad. I'm just saying what is, right? How has that, or will that, in your view, affect your business? Is it irrelevant, meaning it matters, but it doesn't change the core of your mechanics, or is it putting wind at your back and helping you? And for how long? Or talk to me about what you think the impacts of that are, as like, you know, the Venezuela stuff and just this reordering of West and East. Like, how does that help, hurt, or not matter to your core business model?
Well, it clearly throws up uncertainty over what's happening in the world, but actually at the core, it may actually be more likely to be a benefit to us, because this is the rest of the world, how they are dealing with each other. And traditionally, say most of the world finance is controlled out of the US, and the big trading houses are European or American. And we're talking about how the world can trade with each other, admittedly in US dollars, but directly.
Right. So, I mean, if I think about it, it's like, if it doesn't change, meaning if it didn't change, or it was the same as it was for the last however many years, 100 years, you're just you're filling a void that banks have chosen not to fill, and that the trading houses have, despite the arbitrage, still haven't filled, to the tune of $1.5 trillion a year. And so there's a market there regardless. If everything stayed the same in the world order, there's a market. If we go the direction that we've been going, hard and strong, and that becomes, the new world order, the reality is we're still going to be trading in dollars, and but the banks and other institutions will be even more regulated out of the business. And so the gap could get bigger, but you become kind of the neutral, trusted third party for buyer and seller to deal with directly. And so it could help you. Volume.
I think the uncertainty helps us when it comes down to discussing between counterparties how they can trade directly without reference to European or American banks or trading houses. But if it stays the same, we're servicing a huge gap. If it gets worse, we're in a better position, and if it gets better, we're still going to grow. I'm very confident about our position going forward.
Yeah, and I mean, do you see yourselves, the pipeline of 100 million? What does it look like? What's the chicken and egg relationship between pipeline of transactions that couldn't and need your funding and funds available? Like, do you have to have the funds in advance encircled before you can go get the thing? How do you how over your skis can you get as far as deal flow?
Well, we've got trade coming. We've got deal flow coming to us the whole time. I mean, there is a shortage of affordable trade finance. So people are looking at what trade finance they can get, and we have currently 100 million that we're processing that would fit our criteria. At the same time, you don't want to be keeping them on the hook and saying, we might be able to service your requirement when we don't have the funds available. And equally, we don't want to have funds in that we can't deploy.
So you don't want to be sitting on people's money not earning. Yeah,
that exactly. That just depresses our returns to everybody and makes us less attractive.
Very interesting. I mean, and you mentioned coal a bunch, but I know it was just an example.
Yeah.
Are there a list of commodities that coming out of Africa or the regions that you're in that are diverse enough to withstand, let's say, a pandemic type shock on oil, right? So when we had 2020 and oil went to, negative $38 a barrel in April, if something of that nature, a black swan occurred on a commodity, how diversified is your contract mix, and what's that kind of play out like, or what's the hedging that you have in place against any black swans around a certain commodity?
Yeah, I mean, I mentioned coal because there was a particular transaction we're looking at, which kind of really opened my mind and my eyes to actually what the opportunity was. But it is a very small part of what we would look at, not least because there's all kinds of other ESG issues with it. But I mean, our basic strategy ensures that we have a diversification of commodity risk. We wouldn't look to take more than 10% in any one commodity, in any one counterpart, in any one geography. I mean, that's basically where we are pushing towards. So you've got everything from grains, rice, sugar. These are we'd term kind of relatively non-perishable. I mean, they would certainly have a year's worth of life in the very least. Got energy, so you've got oils, edible oils. You've got petrochemicals. You've got metals, so steel, iron, aluminium, copper. You've got metal ores. I think there's a huge variety, all of which are needed. Just to continue modern life and grow.
I'm in the weeds a little bit because I'm just curious of how all of it works. So I'm going to ask a question that kind of takes us a little bit backwards, but I think is relevant too. So when the buyer and the seller transact, everybody's on the same page. You kind of organize essentially a simultaneous closing, right?
Yeah.
And function as the escrow. And who bears the cost of the ship itself? So in other words, you own the coffee or the rice or the corn or the oil or the coal or whatever the heck it is once you close the transaction. So whatever's in the the 9 by 45 foot shipping container on the barge is now the property of Consilient.
Yeah.
But who's paying the ship that's taking it to where it's going? Is that the buyer that already baked that into their cost structure, like they're bearing that cost still?
So we are financing it on a CIF basis. So that would basically be including freight and insurance. So the price that the buyer is paying for the commodity includes the fact that it's currently in I'm going to try something other than Indonesia. It's in Ethiopia and it's being shipped to India. The Indians are buying for something to be delivered in port, and that's what they're paying for equally, and that's what we're financing.
Okay, gotcha, understood. And so the buyer in that case is you're not writing a check to the shipper or to the carrier. The buyer is funding that as part of their transaction price, so it's in there, and
yes,
you're financing that thing. But they're basically paying the shipper directly out of their piece. Or are you sending the escrow to the shipper as part of the single transaction kind of organizer?
Yeah, a key component of this is we have full title to commodity and we have full control over it. So as far as the shipping company is concerned, we are their client. So okay. In the case of default, we own the cargo and we can direct where it goes.
Okay, gotcha. All right, thanks. That's for clarifying. So what questions should I have asked you that I haven't yet to help understand the nuances of your business model and the risk profile and the return profile? And like, what have I not asked you yet that you think is relevant or interesting about the asset class and your approach to being a financier inside of it?
Goodness. I'm not sure how to answer that. I mean, basically, this is a huge market which gives very stable returns, very low risk, and I'm the reason why I've been at this for so long is because I think it's an absolutely brilliant approach, and I'm still trying to poke holes in it myself, because that's how you work out where they are and how they need to be fixed. It's amazing. This is probably this is how business used to be conducted. The Greeks would be doing this in this fashion in kind of 1100 BC. It's only when things got finance moved to a point whereby everything became financialized, that it became complicated, and then the risks moved as the banks took over, and now it's pretty much going back to a structure that would work without the banks.
Yeah, I think that's what I was gleaning a little bit. Is it's kind of, again, history repeating itself, but with new infrastructure and new capabilities. What role are you guys thinking about related to the transparency, the certainty, the risk reduction that AI and agentic AI technologies can provide you in the future, even if you're not doing anything or need it right now? What do you see being available, because of this convergence?
Actually, on that, I've been working very closely with an AI business, which I've been involved with the last 2 years, to help build out the risk management platform. And what we're able to do already is track every single vessel on the planet, determine all their points of control. In a large number of cases, we know exactly what cargoes they're carrying, and we're able to infer from the rest what cargoes they might be carrying, and how that will affect local markets. We are looking to employ it to just basically help determine inconsistencies in paperwork, because commodity trading is very paper heavy, to ensure that so we need to track any and every single piece of paper to make sure they're consistent, so there aren't any gaps whereby you lose control or ownership of commodities. That we're doing all of that, and that's actually one of the reasons, Chris, why we're being a bit slow getting back to you is that we've got a hyperscaler that actually wants to acquire them. So it's been kind of front of mind for the last couple of weeks. But yeah, I
think it's I think it's a very interesting time to be in your business, because people aren't thinking about what you do. We just take it for granted, and then we wonder when we go to our Target and there's not enough toilet paper or there's not enough whatever. Or they like our favorite, whatever, coffee beans are no longer in Costco. We think about supply chain, but we don't really know what that means. We just kind of most of us we take it for granted over here, and yet underneath that there's a transactional component that needs to be funded and de-risked, and there's people that are either doing that or not. One of the things to put on the radar, because it just popped up yesterday. I mean, the last several weeks has been just nuts, as I'm sure you're aware, in the world of AI since OpenClaw dropped, and then you've got almost everybody shipping a new release every single day. Perplexity just dropped one yesterday. Claude does one the day before. OpenAI is doing one next. Gemini's got something coming out. Like it's just the most exciting and nerve-wracking time to be trying to keep up, right? As a business owner, as an investor, as anything. But one of the things that dropped yesterday, I saw it literally right before I was shutting the phone off and getting ready for bed, was World Monitor, which is actually now on GitHub. I'll put a link in the show notes, and happy to send it to you for some diligence on your end. But somebody created essentially this thing called World Monitor. It's 100% MIT licensed open source code base, and it's essentially an intelligence solution that's been made free now that that rivals what states have had for years, and it tracks everything from flights and protests and fires and triggers convergence alerts, and it's 100% open source and can be embedded into anybody's model or agentic solution as a way to track what's going on in the world, ships, everything.
Yeah.
And when you think about how dematerialized and demonetized intelligence like that is today, and that's the worst it's going to be, meaning like that's what shipped last night, and now it's open source. And so now someone in your position can build on top of that whatever unique solution you have to have better information and intelligence tracking your product that you own for your investors, for yourself. It's kind of unnerving because the moats go away, but distribution is everything. And so now you have the ability to spin up infrastructure that, quite frankly, years ago would have cost you millions of dollars or wouldn't have been available.
I mean, data is the most valuable thing out there, and it's becoming very difficult at the moment to keep hold of it. It's going absolutely everywhere. Which is great from our point of view when it comes down to risk management, because the more information you have, that you're able to make sense of, the faster you're able to come to a conclusion over the risk of any transaction. I think it is amazing at the moment. I mean, and saying this view of AI business that I've had over the last couple of years. I mean, we're entering it into a whole new world. It's fascinating.
Well, to think about to kind of finish where we started, right? To think about the fact that when you were on the beginning of this interview, you mentioned that 25 years ago, essentially a boat captain was on the ocean for 30 days. It wasn't until the last couple of days or week that they actually knew where they were going to land the boat or port the boat. Yeah. And when they got there, they had no way of knowing what the price of gas was going to be to fill up until they got there, because of, and that was in the 2000s. That was in the 21st century. Those dynamics occurred. We've gone back and said that peer-to-peer and bankless transactions between buyer and seller and shipper had been done by the Greeks 1100 years. We went back to that lens, and then in the turn of the century, in this 21st century, we still couldn't figure out the price of gas 25 years ago until we got there. And now we're talking about in real time, you with a mobile phone or a laptop could go to GitHub and you could get an intelligence feed that tells you everything that's happening and visibly see it on your phone, from flights to fires to protests to conflict to military vessels to, it's just unbelievable.
But it's a next layer now, which is actually how do you make sense of all this information? What's a key bit that you need to pull out of it? But yes, it is amazing.
That's finding the signal, right? So now it's about finding the signal, and it's about trusted distribution, and that's kind of how I look at it. Is that's kind of a role that you're playing. You're creating a certainty for buyer and seller that the transaction has been agreed upon, is fair, and will be delivered. You're taking the risk off of their side by becoming the single throat to choke, so to speak. You own the commodity. They get to go back to doing what they do. And while it's floating across the ocean, it's your asset, and you're making your money on the spread, and you're de-risking yourself by charging a deposit and taking a 1%-ish average interest while it's on the water from the buyer. And you're simplifying a complex transaction while providing financing to it. And for the investor, they're just getting exposure to an asset class that is in a region that is going to be shipping more and more, that quite frankly doesn't have. There's $1.5 trillion worth of missed opportunity right now that is ready to go, that you're filling 100 million of at a time. That's kind of my takeaways as a summary.
Yeah, Chris. Actually, I'm a bit slow, but you're asking for the question that you should have asked. Why are the banks giving us up? The banks gave us up because of compliance, but why were they sitting on it? This was a core of banking, international trade. It's low risk, steady, consistent returns, and it used to be the preserve of banking, and now it's opening it up for any investor.
And so if compliance is the risk that it's the new cost center that has made them abandon this thing that they probably didn't want to abandon because it was very rich, then are there any risks of regulatory, or is this just going to be something that gets left alone because you don't have the same relationship? Your accredited investors, your LPs, they're very clear on what the risks are and aren't, and they have a redemption period and they can choose, like grown-ups, to allocate their money. In other words, you're outside of any of the regulatory environments that could get clamped down.
This is a non-credit approach, so there isn't the regulation that would be that the banks have when they are financing with debt. We're not financing debt. We are fitting in as a neutral principle, and therefore we don't have the same regulatory constraints.
I'm glad you asked me the question that I forgot to ask you, and then I'm glad I asked you to follow up, because I think that's a clear distinction. Is this is not actually a credit instrument.
It isn't. Right.
It's a principal relationship between the buyer and seller of a transaction that owns the actual hard asset in transit.
Yeah, we are owning commodities that which we get involved in, and we are selling them on 30 to 180 days, self-liquidating with a guaranteed margin on it.
So it's like in the old parlance, right? I make nothing. I own, and I transact. In other words, I basically I find the seller and the buyer before I depart with any capital. And when I depart with capital, the spread is already known and the risk is insured and the collateral is over collateralized. And then I'm basically just selling. I've pre-sold my product, but I didn't have to make it and I didn't have to buy it or use it. I'm just moving. I'm just funding the movement of it from party to party.
And in the process, we are providing working capital for the companies that are on either side of the transaction.
So it's wrong to think of you as a lender. You're not a lender.
We're not a lender, no.
So that therefore means that you can't be regulated into the world that lenders have been regulated to, because the reason why the banks gave up this profit center is because the cost of doing it made it less interesting. It became less profitable because of the compliance and because of some of the things that they now have to deal with.
That's it, exactly. And that's the opportunity that we're opening up, or we've opened up.
Very cool. Very cool. Well, good job, my friend, finding
in the end.
a really non-surface level but systematically global arbitrage opportunity and for making it available. So what's the best way for people to learn more, follow up with you directly? How do you want them to get in touch with you and where?
Well, I can give you my email address and the various website addresses for both Altair and
we'll make sure we'll put all those in the show notes, and they'll be available right inside of the show notes at the top. If you want to get with Matt Cape, again, we've been talking today on the Atomic Level with Matt Cape of Consilient Capital, and I've just gotten a master's degree in an hour on trade finance and all things related to that. And appreciate you joining us today on behalf of myself and the audience. It was great to have you, Matt. Any last words before we sign off?
Chris, no, it's great. Great talking to you.
Awesome. Well, I wish you the best. Look forward to checking in later in the year and seeing how much weight you're moving around the world at that time. But it's a pleasure having you here. We'll see you next time, guys, on the Atomic Level.
Thanks again.